One of my must-reads each week is The Economist. I love their common sense and rational approach to explaining the pros and cons of each situation, whether that's global politics, the economy, or markets. In this week's edition, there's an article called Melting Up, which looks at the factors that could drive stock market valuations even higher in 2021. With global markets already flirting with record highs and setting new records in some cases, what's the likelihood that equities could keep on with their upwards march this year? More to the point, what are the issues that could derail market progress in 2021? I'm going to take a look at a few of my favourite lines in the article, which I'll link to in the description, although you will need a subscription to The Economist to read it. And I'll share my thoughts on how likely these factors are to materialise. Before I get into my analysis of the article, please do hit that like button. The article starts by looking at the fiscal pump priming that's taking place. We've broadly got a couple of things happening at an international level right now. We've got monetary easing, which is central banks printing money and keeping interest rates incredibly low. And then we've got fiscal easing or fiscal stimulus, which is the government spending money on different things, including grants for businesses, the self-employed, and furloughed staff. There's a huge amount of money flooding the system, and it's one factor that could explain why stock valuations are so incredibly high at the moment. When we look at the challenges faced by the economy here in the UK and around the world, recession seems at odds with the stock markets marching on. There is a serious disconnect between the two. The Economist article refers to real interest rates being so low as to make sky-high stocks look cheap. I've referenced this factor in a previous video where I talked about how low interest rates are used to discount the future profits of companies and therefore allow for these very high valuations. In a world where we expect interest rates to remain low for a long time, that explanation seems to support a continued high for equity prices. They then ask the question, which is apparently on the minds of strategists: what is to stop stock market prices worldwide going on a really crazy run? The first factor is the economy. The article notes that markets have managed to look beyond the economic damage caused by COVID since March and look ahead to the post-pandemic recovery. That's the disconnect between markets and the economy I mentioned just a moment ago. Is it still the case that economic recovery is just around the corner? I know we've got the vaccine now being rolled out, with the third one, the Moderna vaccine, being granted regulatory approval in the UK yesterday, but it's going to take some time, and new variants of this virus, the UK variant and the South African one, appear to be driving this latest wave of infections, not just here in the UK, but globally too. While there was cause for optimism about the speed of economic recovery towards the latter part of last year, I think we're starting 2021 in a less optimistic way, or at least in a more realistic way. The second barrier to a market melt-up in 2021 is bullish sentiment. According to this article, investment fund managers haven't been this bullish about equity markets since January 2018. That's based on a monthly survey from Bank of America carried out in December. A large majority of fund managers think the global economy is in the early cycle phase, which means there could be years of growth ahead. But as the article rightly points out, overly bullish sentiment is often a reason to be wary. There's that fantastic quote from Warren Buffett: "It is wise for investors to be fearful when others are greedy, and greedy when others are fearful." Looking back to the start of 2018, the last time investors were so optimistic, and the year ended with heavy stock market losses. The Economist explains that much of the current levels of optimism rely on the belief that monetary and fiscal policies will continue to support the economy. But what if that support gets withdrawn? They refer back to 2010, when stimulus was withdrawn quite abruptly. There are a few factors acting in favour of continued monetary stimulus. In the UK, the Bank of England has confirmed its asset purchase programme at current levels running through until September. And in the US, the $900 billion fiscal stimulus was only passed a little over a week ago and is expected to add 2% to the American economy this year. Another risk to a market melt-up in 2021 is resurgent inflation. I've made a video about this recently, which I'll link up here somewhere, asking whether hyperinflation is a risk this year. But even a modest resurgence in price inflation could pose a risk to equity market valuations. Once this pandemic is over, in the sense that we're all allowed to go out again shopping, eating and holidaying, there's going to be a spending spree. I think that's pretty much accepted. For everyone who's been sitting at home since March, not spending money and instead paying off debt or squirreling it away into savings. It is going to be the mother of all spending sprees, and that could drive up higher price inflation. If that bout of price inflation is temporary, it's not too much of a concern. But what happens if it's sustained? In that scenario, central banks could be forced to hike interest rates, and that could seriously damage equity valuations. While low interest rates today make stock market valuations look, well, not cheap, but not overly expensive, a rise in interest rates could change that picture very quickly. The Economist notes that bond yields have been edging up for months. The 10-year Treasury yield in the US went north of 1% this week for the first time since last March. Markets are expecting rising inflation, still at quite modest rates, but inflation-linked Treasury yields are more or less static, and it's these real yields that are used as a benchmark for stock market valuations. So once again, probably not too much to worry about there. Another risk factor described in the article is debt. We know the government is borrowing a huge amount of money to spend on its coronavirus relief efforts, and businesses have borrowed a lot of money too. Higher debt levels will act as a drag on profitability, and that could feed through into equity market valuations this year. But according to The Economist, that's unlikely to be a heavy drag on prices. So in conclusion, these various obstacles to a stock market melt-up in 2021 really don't appear to be too significant. We've just seen in 2020 that we don't need a good year for the global economy to experience a great year for the global stock market. As long as interest rates remain low, there seems to be a strong case for owning stocks. In fact, and moving away now from the article to more of my own views on this subject, there's always a strong case for owning stocks. Over the longer term, equities outperform other investment types. The key to success with investing is taking that long-term view and accepting that volatility does occur in the short term. The up and down movements in equity markets is the price you pay for that longer-term return. It's this experience of owning equities which makes our behaviour as investors such a determinant of success or failure. If we panic when equity markets wobble, as they often do, and we take money off the table at that time, we can easily get sucked into the sell low, buy high trap. Repeat that a few times and the performance of your portfolio will be pretty miserable. Instead, ignore the market movements, assuming you've got a well-diversified portfolio with diversification not just across the mainstream investment asset classes, but also within your equity portfolio component. Don't rely too much, for example, on a handful of the largest companies in the world or only tech stocks. And assuming you're willing and able to ride out short-term volatility to enjoy those long-term rewards, then equities can and probably should be a central part of your investment portfolio. I quoted Warren Buffett earlier in this video, so here's another one of his quotes to leave you with. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Stick to buying wonderful companies and try not to worry too much about only buying them at wonderful prices. What's your favourite Warren Buffett quote? Let me know in the comments. If you found this video helpful, there's one super quick thing you can do right this second to support my channel. Hit that like button. And if you fancy being an even bigger supporter, why not share this video with your social network or with a friend who you think would get something out of watching it. So press that share button now and make sure you've subscribed too. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.